Billionaire Terry Smith is known as the English Warren Buffett and has a long track record of outperforming the market. And his strategy is relatively simple. He puts it in 3 different ways. Buy good companies, don't overpay, and do nothing. And this is something I was talking about over on Dividend.com actually about a year ago. Now, what's interesting is 13Fs recently released for many super investors, and Terry Smith is one of them. And when we look at the trading activity of his portfolio over the last few months, we can see he reduced his position in many different stocks, pretty much all of his top holdings. But the 2 largest moves he made in his portfolio was adding capital to 2 positions he already owns, Texas Instruments and Zoetis. Now, Terry Smith is an investor that I highly admire, and I pay close attention to the moves he makes in his portfolio. And these 2 moves are particularly interesting, so I want to take a closer look at both of them. Now to start, Texas Instruments is a stock that I actually own in my personal portfolio, and I've been covering it on the channel for years now, and over the past decade, it has certainly outperformed the market, especially if you include the dividends that it's paid out. But if we look at the last year, it's actually down by about 10.64%, trading at $176.30 per share. Now, if we look at the stock strictly from a dividend perspective, you'll notice some interesting takeaways. The data will automatically load in, and like always, if you'd like to get access to any of my spreadsheets and also access to the ticker data add-on on Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, we can see the starting dividend yield for Texas Instruments is over 3%, so that's a pretty solid starting dividend yield, and the 10-year dividend CAGR is sitting above 14.41%. So historically speaking, they've grown dividends at a pretty high rate. I mean, the 2014 dividend was $1.24, and in 2024, $5.26. So that's a significant increase in the amount they're paying out in dividends. But if you're paying close attention, I already know you see the red flag. Look at the free cash flow payout ratio over the past year, 320%. That means the amount they paid out in dividends was $4.8 billion, while the amount they generated in free cash flow was about $1.5 billion. Now, historically speaking, the free cash flow payout ratio has remained in a relatively healthy range, sitting between about 40 and 60%, which for a stock like Texas Instruments that has grown dividends and grown free cash flow at a healthy rate, that's a pretty healthy free cash flow payout ratio. So what in the world has happened over the past couple of years to make the free cash flow payout ratio skyrocket like this? And this is why it's so important to truly understand what's going on with the company. Now, let me back up for a moment. We're going to jump over to their investors presentation, but we have to make sure we understand free cash flow. Free cash flow is the single most important metric for any stock that you're looking at, because management teams have 5 options with free cash flow. They can reinvest back into the business, attempt mergers and acquisitions, pay down debt, buy back shares, and pay out dividends. So essentially, all 5 of these are ways that management can reward shareholders, and again, it boils down to free cash flow. And if we jump over to the investors relation page for Texas Instruments, this is going to sound nerdy, but they have my favorite investors relations page, and let me show you why. The very first thing you see is a quote from the chairman of the board, Rich Templeton. The best measure to judge a company's performance over time is growth of free cash flow per share, and we believe that's what drives long-term value for our owners. He is 100% right. This is what I harp on all the time. And if we come down just a little bit lower, he points this out in a couple of different ways. 21 consecutive years of dividend increases with a 23% dividend CAGR from 2004 to 2024. Extremely impressive. And during that time period, the share count reduction was 47%. They reduced shares outstanding by 47%. So for example, if we jump over to the stock screener, I've already plugged in Texas Instruments. We can see they're buying back shares consistently every single quarter, meaning as a shareholder, you're getting more equity in the company. And it also helps boost all the other per share metrics. So it's clear Texas Instruments management is focused on rewarding shareholders. They're focused on growing free cash flow. That's exactly what I want to hear. So if that's the case, why do we see such a drastic drop in free cash flow per share in 2023 and 2024? And again, this is why it's so important to actually understand what's going on with this company. If we jump over to their investors presentation, they state on one of the very first slides, our capital allocation approach remains focused on supporting the opportunity ahead. We are nearly 70% through a 6-year elevated CapEx cycle that, when completed, will uniquely position Texas Instruments to deliver dependable, low-cost 300mm capacity at scale to meet customers' demand, scalability of CapEx including capacity modularity, free cash flow per share growth across a range of market conditions. Okay, that was a mouthful. What does this mean? Well, essentially, Texas Instruments has been going through a planned period of higher than normal capital expenditures. And they stated they're nearly 70% of the way through with this higher than normal capital expenditure period. Now, an increase in capital expenditures means that free cash flow and free cash flow per share is going to be lower. So this lower free cash flow was no accident. This was actually the plan by management. And if we scroll down to the 8th slide, we can see why. It's to increase the organic growth of the business over the very long term. And here's one of the key benefits of this. The investments in manufacturing capacity will support growth for decades to come. They're also going to have control of their own supply. Greater than 90% of their wafers, assembly, and tests will be manufactured internally. This will be a major competitive advantage for the company. But perhaps the greatest advantage for Texas Instruments is chip costs are now going to be 40% less. This is a huge deal for the overall profitability of the company. For example, if we go ahead and jump over to my profitability and income statement sheet, let's come up here and plug in Texas Instruments. Here's what I want to point out. If we look at the gross profit ratio for this company over the past decade, for the most part, it's been above 60% in this time period. The 10-year average gross profit ratio is about 62.83%, but we can see in the last couple of years, it has started to decline. Now, in the grand scheme of things, obviously they're still profitable. 58% is pretty solid for their sector, but we don't want to see it declining over time. But again, this is due to the planned period of higher than normal capital expenditures, and when this is over, chip costs should decrease by 40% for this company. And so management lays out what the end plan, what the end goal for these capital expenditures are. We can see this charted out. Again, they're showing free cash flow per share. Why is this important? Well, again, free cash flow per share over the long term is what drives shareholder returns. They've made this clear. So we can see the free cash flow per share trend line charted out right here, and then we have the period of elevated capital expenditures. What they're stating is the plan is by the end of 2026, free cash flow per share should get back in line with this blue area here. And they do a little sensitivity analysis over here with different revenue scenarios. And on the low end, they state $20 billion in revenue, which would give them a 0% compounded annual growth rate since 2020. What would the result of this be? Well, free cash flow per share would come out to about $8 to $9. And if we look at the free cash flow per share over on the stock screener, that would be an all-time high. In 2022, it was $6.47. So that would put 2026 free cash flow per share all the way above the chart up here. So when you actually understand what's going on with the business a little bit more, you can still see the potential for great gains in the future. Even though we've seen the earnings decline and free cash flow per share decline in the last couple of years, it's really all a part of the plan. Now, it's important to keep in mind this means typical valuation models aren't going to really make sense for Texas Instruments right now. For example, if we look at the historical multiple valuation for Texas Instruments, here's what we can see. The trailing 12 months PE ratio is almost 33 when the average PE ratio is 23.3. So technically speaking, based on this valuation, Texas Instruments is being valued 41% higher than its historical multiple, which typically means the company's overvalued. But we have to remember, the PE ratio is derived by looking at the current price of the stock while also looking at the earnings per share. And earnings per share right now is lower for the company because of the planned capital expenditures. So even this valuation model is lying to you in this scenario. Now, the other big question we do need to look at this moment is, what about the dividend? Is it still sustainable over the next couple of years with a 320% payout ratio? And this is a great question. It's important to remember that by 2026, free cash flow should start easily covering that dividend once again. But what about for the next couple of years? What's going on with the company's balance sheet? And if we jump over to the balance sheet breakdown and look at Texas Instruments, what we can see is the company sitting on a very healthy cash position. The debt to assets ratio is just 0.38. So total assets at $35.5 billion and total debt at $13.5 billion, but perhaps even more importantly is the current ratio. This is telling us how easily the company can meet its short-term obligations, and total current assets, so things like cash and cash equivalents, is sitting at over $15 billion, while total current liabilities is only $3.6 billion. So from a balance sheet perspective, the company actually still looks very healthy. So getting through these next couple of years of higher than normal capital expenditures shouldn't be a problem for the company. Maybe the dividend growth will be a little bit lower in the next couple of years, but they should still be able to sustain that dividend. So again, valuation is pretty difficult in the scenario of Texas Instruments right now because at the end of the day, it just boils down to how well are those capital expenditures going to pay off after 2026. But even if we just assume a 6% dividend growth rate moving forward, we can see we'd come to a dividend discount model price per share of $228.11, which is about 30% higher than the current share price for this company. So when I look at the recent trading activity of Terry Smith and I see this huge addition to Texas Instruments, really the only logical explanation is he really expects these capital expenditures to pay off quite well. Historically speaking, this has been a stock that's grown free cash flow at a high rate, grown their dividends at a high rate, and done a great job of rewarding shareholders, and he seems to be betting that management will continue to be able to do that in the future. Then we come to the second major move that Terry Smith made, and that was adding quite a bit more Zoetis to his portfolio. And if you aren't familiar with this company over the past decade, again, they have outperformed the market up by about 226%. And if we look at them in the last year, though, they're actually down by about 5%. Now, if you've never heard of this company, who are they? What do they do? Well, it's actually pretty straightforward. They are the world leader in animal health. And the investment thesis is actually pretty straightforward. When we think about it, what do we want from our investments? Overall, companies that have major competitive advantages have pricing power. In a study that was published in 2022, 86% of pet owners would pay whatever it takes if their pet needed extensive veterinarian care. Gen Z and millennials are fueling the humanization of pets. High-income households often have more than one pet and are more willing to spend during a down economy. When faced with a 20% decrease in budget, pet owners will not spend less on their pets. This company has a major competitive advantage when it comes to the predictability of their cash flows, when it comes to their pricing power. Now, typically when I make an investment into a stock, I want to see a lot of growth in the sector itself, not just in the stock. And we could see expected market growth for Zoetis from 2023 to 2028 was about 6% compounded annual growth rate, which is decent, but typically I like to see it higher than that. But here's what we have to understand. Zoetis has consistently grown faster than the animal health market as a whole. They've achieved an 8% revenue CAGR since their IPO in 2013 compared to the 5% for the animal health industry. And if we look at the 20th slide on their investors presentation, they state that that's one of their goals, grow revenue faster than the market. They want to invest in innovation and growth capability so they can continue to grow in the future, but this next one is quite interesting. They want to increase adjusted net income faster than revenue. Now, at first glance, it sounds like it'd be difficult to sustain that over the long term, but actually many companies have been able to achieve this in the past if they're high quality. Again, this is something I was talking about on Dividendology.com not too long ago. Every type of growth indicates something about a company. And as you move down the income statement, each type of growth has the ability to grow faster than the metric above it. What do I mean by this? Well, revenue, obviously that's all the money that actually comes into the company. But in terms of a growth rate percentage, gross profit can grow faster than revenue if the company is expanding its gross margins. The same is true with operating profit. The same can be true with net income. The same can be true with free cash flow, and it can even be true on a per share basis if a company is buying back their stock. And there's a great example of this with Applied Materials. Applied Materials had a 5-year period where revenue grew by about 9.7% annually, but gross profit grew by 10.5%. Operating profit grew by 11.3%. Net income grew by 17.7%. Free cash flow grew by 19.1%, and free cash flow per share, because they were buying back stock, grew by 23.9%. Now, what's the end result of this? The end result is because the company's becoming higher quality, investors are willing to pay a higher multiple for the stock, so share price grew by 29% annually. And that's exactly what Zoetis has stated they're attempting to do. And then on top of this, they stated they're going to return excess capital to shareholders. And historically speaking, what a phenomenal dividend growth stock this has been. If we plug in the ticker on the dividend growth sheet, right now we can see the company has a starting dividend yield on the lower end at 1.23%, but that's because they grow their dividend at such a fast rate. The 5-year dividend CAGR is above 20%, and the 10-year is right at 20% as well. So they've seen rapid dividend growth over the past decade, and again, that's because it's been backed by growing free cash flow at a high rate. The free cash flow payout ratio last year was just 34.2%, leaving plenty of room for reinvestment back into the business. So if we look at Zoetis from a dividend perspective, what I want to do is simply look at that dividend yield on cost here on Seeking Alpha. If we look at this charted out, yes, the yield is low, but if you bought around 10 years ago, your yield on cost would now be closer to about 5%. And if they continue to grow that dividend, that will only compound. Now, one of the things that makes Zoetis interesting right now is the valuation multiple that it trades at. Historically speaking, this company is traded at quite a premium. If we look at the PE ratio, non-GAAP for the trailing 12 months, it's sitting about 27.01. But the company's 5-year average is sitting at 36.94. It's historically traded at quite a premium. In fact, its current multiple is around 27% lower than its historic average. If we look at it on a forward-looking basis, the same still remains true. It's about 26% cheaper than it's historically traded. Now, a company can deserve to have a lower PE ratio if the growth projections for the company's future earnings, future revenue, has gone down. So let's see if that's the case. In their recent earnings report, they gave updated 2025 guidance. We can see what the prior guidance for 2025 was right here, but if you look at the guidance right now, it's even higher than the prior guidance. So they're actually increasing their growth projections over 2025, at least when it comes to revenue. The same is also true with adjusted net income. If we look at the growth of this company historically speaking, earnings in 2015 were just 68 cents per share, and in 2024 all the way up to $5.47. So we are talking about a company that has really grown free cash flow, earnings, and revenue at a very high rate over the past decade. And one of the most clear signs of a company with a competitive advantage is going to be return on invested capital and steady and high gross profit margins. And if we look at Zoetis, we can see return on invested capital last year was 22.2%. Anytime a company is getting close to 20% or above 20%, that's a very good return on invested capital. Again, remember, this is telling us how profitable are the projects the company is investing their capital into, and it's consistently been above 15% since 2018. If we jump over to our profitability sheet and look at Zoetis, what we can see is not only is the gross profit ratio high, but it's climbing even higher. 10-year average gross profit ratio is 67.6%. Last year's came in at 70.62%, another sign of a competitive advantage. So from a quality perspective, it's easy to see why Terry Smith was interested in this company. It obviously has some quality characteristics, but let's take another moment to talk about the valuation. As I already pointed out, compared to how it's historically traded, the company does look undervalued. But what about the other valuation models? If we go and jump over to my stock valuation sheet, I plugged in ZTS. Again, this is available on tickerdata.com, but let's jump over to our discounted cash flow analysis. Again, we're just valuing the company based on how much future free cash flow they're going to produce. In this example, we're going to assume a free cash flow growth rate moving forward of 10%, which is actually quite a bit lower than the company has historically seen at about 18.22%. So perhaps we're being a little more on the conservative side with our projections, but estimates are a little bit lower for the next few years. But with a 10% free cash flow growth rate, we come to an intrinsic value of about $130 per share, which the current share price is at $162. So our DCF model says the company is worth about 20% less than it's currently trading at. But if we move forward and look at our dividend discount model, we can see, assuming a dividend growth rate of 7.25%, which has been easily attained for the company over the past 5 and 10 years, the company would be worth about $171.60 per share, or about 5 to 6% higher than the current share price. So if we average those two valuations together, we'd come to an intrinsic value of about $150, which is only around 8% off from the current share price. So again, when I look at Zoetis, it's easy for me to see why Terry Smith was interested in adding more capital to this stock. Historically speaking, it's traded at a very premium valuation because it has premium characteristics. Texas Instruments is a stock that I own in my personal portfolio, and Zoetis is a stock that's on my watch list that I am watching closely. Like always, if you'd like to download any of my spreadsheets and also get access to the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.